Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Dollar General Corporation Annual Report. Dollar General Corporation offers a wide range of products across various categories. The company provides consumable products such as paper towels, bath tissues, laundry products, and disinfectants. It also offers packaged food items like cereals, pasta, canned soups, and fruits and vegetables. In addition to these essentials, Dollar General sells perishables including milk, eggs, bread, refrigerated and frozen food, beer, wine, and produce. The company's product line also includes over-the-counter medicines, personal care products, pet supplies, and tobacco products. Furthermore, Dollar General provides seasonal products like holiday items, toys, batteries, small electronics, greeting cards, and gardening supplies. Home products offered by the company include kitchen supplies, cookware, small appliances, light bulbs, storage containers, frames, candles, craft supplies, and bed and bath soft goods. The company also offers apparel products for infants, toddlers, girls, boys, women, and men, as well as socks, underwear, disposable diapers, shoes, and accessories. Overall, Dollar General Corporation provides a vast array of merchandise products to its customers across the United States. Dollar General Corporation maintains a market capitalization of $27 billion, broadly in line with the industry peer group. Dollar General Corporation trades at a lower price-to-earnings ratio of 18 times and a lower price-to-book ratio of 3.22 times relative within the industry. This makes the stock valued slightly lower than its peers in the industry. This likely suggests that investors are less interested about the company, or it could be that the stock have not caught up to the industry valuation and should further be investigated. The leverage on the balance sheet appears elevated, with liabilities of 76% of total assets. This raises some concern, and we should examine the industry and nature of the business to determine whether they justify the elevated leverage. Average liabilities have increased over the past 5 years, which is normal for a growing company. Asset and equity growth have outpaced liabilities, suggesting balanced and healthy expansion. Shareholder equity has grown consistently, but operating income growth is weak or inconsistent. Equity expansion may be driven by financing activities rather than core business profitability. The company has consistently reduced its share count, while revenue and equity have grown, indicating disciplined buybacks that enhance long-term per-share value. The income statement shows that the company have been growing its revenue annually, but the operating income have not been increasing. This shows that the business is under pressure with rising cost. The primary drivers of revenue growth for a company can be attributed to several key factors. One major driver is the optimization of sales mix, which involves strategically adjusting product offerings and pricing to maximize revenue. The adoption of digital tools and technology, such as mobile apps, also plays a significant role in driving revenue growth by enhancing customer engagement and convenience. Another crucial factor is the expansion of services, including third-party delivery options and remodels under Project Elevate. New store openings are also a key driver of revenue growth, with plans to open over 1,000 new locations in the next 2 years. Furthermore, the growth of the consumables category has been consistently high, reaching 82% in 2025. On the other hand, there are several drivers that can lead to revenue decline. One major factor is elevated damages levels, which can result from various factors such as supply chain disruptions or inventory management issues. Markdowns needed to sell excess inventory can also have a negative impact on revenue. Additionally, sales in the consumables category, although improving slightly, remain a challenge. External factors such as tariffs, unemployment rates, inflation, wage growth, and changes in tax policies can also influence revenue growth or decline. However, these factors are often outside of a company's control and may have varying impacts depending on the specific context. Net income and profit margins experienced fluctuations between 2023 and 2026. Initially, net income decreased in 2024 compared to the previous year due to impairment charges, insurance liabilities, and contingent liabilities. This decline was accompanied by a decrease in profit margins, primarily attributed to inventory shrinkage, damages, and markdowns on unseasonal inventory. In 2025, net income rebounded as disruptions to the distribution network, transportation costs, labor shortages, and cost overruns were addressed. However, this improvement was short-lived, as net income decreased again in 2026 due to various factors not specified in the provided text. Profit margins also experienced a decline in 2025, mainly caused by the failure of private brands to improve their gross profit rate and intense competition. Nevertheless, profit margins increased in 2026 compared to the previous year, indicating a positive trend. The company's financial performance indicates a strong ability to generate cash from its core operations. The net operating cash flow stands at $4.7 billion, which is calculated by subtracting capital expenditures from aggregate cash flows from operating activities. This positive figure suggests that the company is successfully managing its day-to-day business and generating sufficient funds to cover its expenses. Furthermore, an increase in operating cash flow of $638.4 million from 2024 to 2025 confirms this trend. This growth in operating cash flow indicates a strengthening financial position for the company, allowing it to invest in its operations, pay off debts, or return value to shareholders. Overall, the data suggests that the company is generating positive operating cash flow, which is a key indicator of its financial health and stability. The company's debt level and interest expenses have undergone significant changes over the past few years. Initially, the long-term debt decreased from $4.65 billion to $2.59 billion between two unspecified dates, indicating a reduction of $2.05 billion. By January 30, 2026, the debt level had further decreased to $2.375 billion. In terms of interest expenses, there was a notable decrease in 2025 compared to 2024, with a drop of 15.9% and $43.8 million respectively. The interest expense also saw a significant reduction from $2.04 billion in 2024 to $1.08 billion in 2025, indicating a decrease of $963.3 million. The trend continued into 2026, where the interest expenses decreased by another 15.1% compared to 2025. The net interest expense for 2026 was reported at $230,567,000, which is lower than both 2024 and 2025. Overall, the company's debt level has been decreasing over time, while its interest expenses have also seen a significant reduction in recent years. The performance of various segments in the industry can be observed through the extracted summaries. One notable segment that performed well is consumables, which saw improvement in 2025 compared to previous years. In contrast, the seasonal segment experienced a slight decline from 2023 to 2024, but rebounded in 2025. This indicates some level of volatility in this segment's performance over the 3-year period. The home products and apparel segments demonstrated consistent revenue over the 3-year period, with no significant increase or decrease. This stability suggests that these segments have maintained a steady market presence despite fluctuations in other areas. Management is optimistic about the company's outlook, citing several key strategies to drive growth. The primary goal is to achieve profitable sales growth through capturing new opportunities both domestically and internationally. To this end, the company plans to invest in digital marketing and customer data security, expand its international presence, and introduce a new retail concept called P-Opshelf. In terms of specific initiatives, management will focus on store remodels and relocations, as well as investing in real estate. The company also aims to enhance its position as a low-cost operator by managing costs effectively, including labor and occupancy expenses. Additionally, management is committed to investing in employee development to reduce turnover and improve key performance indicators. Looking ahead, the company projects capital expenditures of $1.4 billion to $1.5 billion for 2026, with a focus on strategic investments that will drive growth and profitability. Overall, management's strategy is centered around capturing new opportunities, managing costs effectively, and investing in employee development and digital tools to drive long-term success. The company's financial activities have been multifaceted. On one hand, the company has demonstrated a commitment to returning value to its shareholders through dividend payments. This indicates that the company is generating sufficient profits to distribute a portion of them back to investors. On the other hand, the company has also engaged in share buybacks, which suggests that management believes the stock price does not accurately reflect the company's intrinsic value. By purchasing shares, the company can reduce its outstanding share count and potentially boost earnings per share, thereby increasing shareholder value. Concerns about inventory buildup and supply chain disruption the extracted summaries reveal widespread concerns about inventory buildup and supply chain disruption. On page 13, inventory buildup is mentioned as a concern, while page 14 highlights the risks of supply chain disruption due to cyber attacks and system breaches. Furthermore, pages 15-17 emphasize various factors that could lead to supply chain disruptions, including supplier unavailability, changes in pricing terms, pandemic outbreaks, natural disasters, and extreme weather conditions. The potential impact on private brand initiatives is also noted on page 19, with transportation disruptions posing a significant threat during the Christmas season. The significance of inventory levels is underscored by page 39, which reveals that approximately 44% of total assets are tied up in inventory as of January 30, 2026. Pages 41 highlights concerns about inventory buildup due to estimated shrinkage and timely recording of markdowns needed to sell excess inventory. Overall, the summary suggests that inventory buildup and supply chain disruption are pressing concerns that require attention and mitigation strategies to prevent potential losses. That concludes the financial summary for Dollar General Corporation. Feel free to comment below, and I will be happy to answer them when possible.